All right. Good morning, everybody, or afternoon, depending on where you are. Thanks for joining our presentation today. Today, we're going to talk about 457B and 457F plans for tax-exempt nonprofit organizations. Just a note, these are not for governmental plans. Those are different 457Bs. So I'm Brian Montanez, and you've joined our Multnomah Group series of continuing education webinars. Multnomah Group is an institutional retirement plan consulting firm and fiduciary investment advisory firm. We try to bring ERISA-based best practices to our clients to help them address all aspects of compliance, administration, and fiduciary oversight. At an organizational level, we work with 177 different clients, sponsoring 298 different plans. They come from for-profit, not-for-profit, governmental, tribal, you name it, we're working with them. We're currently handling, as of September 30, just over $44 billion in total plan assets. As a firm, we have 21 years of experience. As you can tell by the gray on my face, I have a little bit more than 21 years. And we serve clients in 17 states. As I mentioned, my name is Brian Montanez. I'm a principal with the firm. I work with clients mostly in the Western states and Hawaii. I work with pretty much any type of entity that you can think of, and pretty much any type of retirement plan, qualified or non-qualified, that you can think of. That is how I spend my entire day, is working with clients on institutional retirement plans. So why are we here? First off, to get a better understanding of 457 plans. But we're also here because the IRS has stepped up their audit of 457 plans in the past handful of years. And yes, I've had to help a couple clients work through IRS audits. The IRS may come knocking on your door. And when they do, this is what they tell me they are looking for. So they're looking to see if there have been timely adoption of the original plan documents and amendments. And in working with clients, and when I take over new clients, I do actually see that the qualified plan, your 401k, your 403b is reasonably well attended to, but the 457s tend to get left in the wayside. The IRS is looking to make sure that a group of eligible employees have been properly limited to a select group of employees. They're looking to see whether there's been compliance with the annual contribution limits and special catch-up rules. And by the way, we're going to talk about every single one of these bullet points in depth today. And I did not address this earlier, so let me do it now. At the end of each slide, I'll pause to give the opportunity for questions. And then there will be a slide at the end where I'll try to address your questions. The IRS is also coming in to look at whether there's been compliance with the rules governing the time and manner of distributions. That is a common error that I see with clients, is when they when they force their employees out of the plans. Whether FICA and income taxes have been properly and timely withheld, I do see a lot of confusion there with clients. And whether the top hat notice, which is required by the DOL regulations, was properly filed. As I mentioned, we're going to talk about all of this stuff in depth. We're going to talk about eligible employers, why plan sponsors offer these retirement plans, the application of the IRS, ERISA, and an ERISA exemption, eligibility, security of assets, contribution limits, vesting, distribution rules, taxation, available investments, and as I mentioned, I will leave a spot for questions at the end. So the first point, eligible employers. Again, these are not for governmental plans. They are a different set of rules. These are non-qualified deferred comp plans, are for employer-sponsored plans of a 501c3 or other non-governmental tax-exempt organization for a select group of employees. 457 governmentals are a different family. Generally, those who participate in the 457B plan defer a portion of their annual compensation, but employers may also contribute. Generally, those who participate in the 457F plan have the employer contribute, but eligible participants can defer up to 100% of compensation if the plan document allows it, but that's a risky proposition. I'm going to talk about why it's risky a little bit later today. 457Bs are defined contribution plans, meaning I or the employer define the contribution to the plan. A 457F can be a defined contribution, or it can be a defined benefit plan where the employer defines the benefit the employee will receive at a future date. Why offer 457 plans? Well, they can be a solution to employer contribution limits imposed by the IRS. And they can be additional tax-deferred saving vehicles for highly compensated employees. These two are the most common that I see, and I'll just give an imaginary example. So you have a CEO who makes $500,000, and the employer contribution to the retirement plan is 10%. Well, we know the employer is not getting $50,000 in the retirement plan because there's IRS compensation limits of $350,000 this year, meaning when you calculate your employer contribution for your qualified plan, the IRS says you can only consider the first $350,000. So that CEO is not getting their full employer contribution into their qualified plan. So we can use a 457 plan as a spillover to make sure that that delta of $500,000 and $350,000, that $150,000 of compensation that's not included in the qualified plan, we can make the employer contribution on that 150 in one of these 457 plans. Then that highly compensated employee is getting the full employer contribution, although it's coming over into two plans. The second bullet point, additional tax deferred saving vehicles. Well, if I need to save 10 to 15% a year, and again, crocodile tears, but if I make $500,000 a year, I can't save $50,000, 10% of 500,000 in a 401k or a 403b, because the IRS limits the amount I can put into 23,500. And yes, somebody just said, all that gray, you get the age 50 catch up. I do. But even then, we're only talking about $31,000. I don't, that's not going to be 10% of my compensation. So 457 plans would allow me an additional tax savings vehicle to put more money away for my retirement. It can assist in recruiting highly sought after employees, and they can be golden handcuffs, meaning we will pay you a benefit at a future date. But if you leave before that, you don't get anything. So nitty gritty, the application of IRS, ERISA, and ERISA exemptions. So all deferred compensation agreements of nonprofit organizations must comply with Section 457 of the IRS code, meaning compensation limits, right? So deferral limits. We just talked about 23,000 plus the age 70 catch up, whatever the numbers are. The IRS defines what the benefit can and will be. 457 plans are non-qualified plans, therefore not subject to non-discrimination testing. So this is one of the first questions I get when we set up one of these plans is, well, do I have to do testing? If I'm going to only benefit highly compensated employees, aren't I going to fail testing? No, there's no testing on 457Bs because they're not qualified plans. 457 plans are not subject to ERISA, but do have to file a TAT exemption letter. What I mean by that is a 457 plan is subject to ERISA until you file the top hat exemption letter with the DOL. And you need to do that within the first 120 days of the plan's inception. What this is really a birth announcement to the DOL that it exists. You don't have to do any ongoing filings. You're not going to get a response from the DOL. Maybe you get an acknowledgement letter, but there's no ongoing communication with the DOL. You just have to let them know that you have a 457B plan. If you don't file that top hat exemption letter, it is subject to ERISA with disclosure rules, notice rules, federal filing rules. So if you don't know right here, right now, if you have filed that top hat exemption letter, you can go to this URL, type in the EIN of the organization, and you can see if they have a copy of your top hat exemption filing on record. If you do, download it, keep it, store it. If you don't, you can file a delinquent filer voluntary compliance resolution. Not expensive. It's going to take a little bit of your time, or maybe you engage an attorney to do it. But better to do it now before the DOL comes in than after they come in and ask you for the top hat exemption letter. We will send these slides out later, so if you didn't get the URL, you'll get them probably tomorrow in your email. 457Bs must limit to a select group of people to maintain tax favored status. 457F assets and compensation must be subject to substantial risk of forfeiture. I'm going to talk more about both those a little bit later. What is substantial risk of forfeiture? Functionally, a substantial risk of forfeiture exists where the rights of the property, the assets, are transferred or conditioned directly or indirectly upon the future performance or refraining from performance of substantial services. Meaning, I'm going to leave my assets with the organization. By the way, I'm getting ahead of myself now, but those assets are subject to creditors. And those assets will stay there as long as I continue to provide some sort of service for the organization. But the reality is they're not my assets. They are the assets of the employer. This is a deferred compensation plan, meaning I'm not receiving compensation and then putting it into my 401k or 403b. I am deferring the receipt of that. So it is an asset of the organization and a liability for your financial statements, folks. It's an asset and a liability of the organization, but it is not mine. Source of plan documents, this actually changed, or at least for me in the last year or two. So 457B is usually provided as an adoption agreement from your record keeper. Maybe it's 5-6 pages, couple simple boxes, pretty easy stuff. 457Fs, these are more complicated. These are contracts. They're employment contracts. They're compensation contracts. They have to abide by the IRC and 409A. So there's specific language and rules that have to be in them. And because of the uniqueness and the specificity of the language that has to be in them, they are traditionally handled by outside counsel. Only recently have I started to see record keepers provide a 457F. But generally speaking, it's going to be written by an attorney. A 457B will come from the record keeper. A 457F will generally come from an attorney. But you might want to start asking your record keepers if they can provide document services on your 457Fs. For an F, a separate plan document is not necessarily required for 457F. So if you don't have an actual plan document, well, first that's a red flag, but the employment contract may have all the T's and C's that meet 409A so that it is a 457F plan. If you don't have a plan document, you might want to have your attorney take a look at the employment contract. If you have a plan document that hasn't been looked at by an attorney in the last handful of years, I would suggest you actually do have an attorney look at your document as well.
Brian, we do have a question. Does a 457F plan need a top hat exemption filed or only the 457B?
Both 457s need top hat exemptions. So yes, your F needs an exemption. Eligibility. So 457B plans are generally limited to a select group of management or highly compensated employees. There is no bright line. It's a facts and circumstance rule. Generally, the employee population is a population who is a key management employee, earns a salary substantially higher than the other employees. Over the years, though, the courts and the Department of Labor have looked at one or more factors: total employees versus the number of employees covered under the plan, the average salaries of a select group versus the average salaries of the other employees, the average salaries of the select group versus average salary of all management or highly compensated employees, the range of salaries of employees in the select group, and to the extent to which a select group can negotiate salaries and compensation packages. Informal guidance says to limit to 10% or less of full-time employees. However, there is a court case, Demery versus Extabank Deferred Compensation Plan, where the courts did allow 15.34% to be an eligible class for a 457B. So do I want to go to court to defend 15%? No. In my years of working with nonprofit organizations, I have seen clients try to push the 10% number, but I've never seen the participants actually get anywhere near 10%. Even if they said, we're going to allow these 52 people in because that's 10%, it might only be 6, 7, 8, 9 people that actually use it. So I see no real practical reason to push these limits. And I definitely don't see a reason in any of my client book to push a court case. 457F plans generally are further restricted to only the senior most employees or a targeted hire. So A1 or 2, A3. I think my largest client, which is about $1 billion, that only has one eligible for an F. Most of my nonprofit organizations where we have Fs, it's only one, and it's the senior head of the school. So 457Bs, sure, out to 10%. 457Fs, generally it's only one or two people. If you think about what I've said so far, wait a minute, I have to have an attorney write a contract for this? You're talking about $5,000 for an attorney to write your plan document or your contract for an F. You're not going to throw that out to too many people. Security of assets and funding of plans. So security. 457B and 457F plan assets are held as part of general assets of the employer. That's what I was saying before. They're not my assets. They're not protected by ERISA because they're not exempt. They're not subject to ERISA. You have no protection from creditors. These assets belong to the organization. These plans are subject to attachment by creditors of the employer in the event of bankruptcy. This includes employee salary deferrals. Wait a minute, what? So if I put money into my 457B and I defer my own money, it's still subject to creditors and bankruptcy. There is a security mechanism that you can put in place to provide a measure of protection, and it's called a rabbi trust. A rabbi trust is a trust established by an employer to provide a source of funds that may be used to satisfy the employer's obligation to execute to executives under a non-qualified plan. That's a very verbose way to say it limits the use of those assets. So a rabbi trust says the money in the rabbi trust can only be used for one specific purpose, and it's to pay the benefit. Meaning, if the employer's organization needs to get their hands on a couple bucks to make payroll or to invest in its business, the CFO may not use the money in the rabbi trust. But if it's not in the rabbi trust, the CFO could actually use your money for whatever they want to use it for. Why? Because it's not your money. It's the employer's money until you vest. Funding. 457Bs are funded, meaning I'm going to put money away, but not necessarily self-directed. So most 457Bs, I will put my money in, the employer will put a little money in, and I get to invest it just like I do with my 401k or 403B. A 457F, however, is different. It may be funded or unfunded and may be self-directed or not, meaning the employer could say, we'll pay you $200,000 at the end of 5 years. They don't have to put that money in a plan today. They can just have a liability to pay you $200,000 in 5 years. Or we'll pay you $50,000 a year for the next 5 years until that project is complete. They can put the $50,000 in the plan. They don't necessarily have to let you invest it, or they can allow you to invest it. So 457Bs, the money goes in the plan, and generally the participants get to invest them. 457Fs, it really is all across the board. It depends on what the benefit is how the benefit is trying to be structured. It may be money going in on a monthly basis, on an annual basis that the participant can invest. It may be money that goes in on an annual basis, or just money that goes in at the end of the year, or it may not have any money going in, but a liability to pay you a benefit in the future. Please, if you have questions, jump in. Contribution limits. One of the big challenges that I see with nonprofit 457Bs. So section 457E15 of the IRS code, what's that? That's 402G for 401ks and 403Bs. What's that? That's the number that says, hey, I can only defer $23,500 this year of my own money. It follows the 401k and 403B limits. So 457B allows only $23,500 in the plan in any 1 year. And their cash flow. So at the end of the year, if you decide to make your employer contribution, so let's just say I had a 2024 plan year, and then January of 25, okay, let's make our employer contribution, and you put that money in January of 25, that goes against the 25 contribution limits, not the 24. 457Bs are cash flow. Employer contributions can be fixed or discretionary and determined separately for each covered executive because there's no non-discrimination testing requirements. Now, if you go back and do what I said earlier, which is, okay, we're going to look at our 401k, our 403b, and the senior employee is not getting that full 10%. At the end of the year, we're going to calculate the delta, and we're going to give them the 10% of that $150,000, that $15,000, and we'll make that contribution in January. That $15,000 goes against the January 2025 limit. So that only leaves $8,500 of salary deferral. That's a little bit weird, isn't it, though? Because employee salary deferrals and employer contributions, or both, but they both count towards $23,500. It's not $23,500 of salary deferral and the employer contribution. These contribution limits are combined. So if the employer puts in money, that reduces the amount that I can put in myself. Or if I put in money, that reduces the amount the employer can put in. $23,500 is the combined contribution limit for a 457B. Do not count towards maximum annual contributions allowed under the 401k, 403b, or 401a. So if I have my 401k or 403b plan, that has its own set of limits, and I can get my max benefits in there. The 457Bs are completely separate. They're not aggregated. So I can max out my 403B from the employee and or employer contributions, and I can max out the 457B. They're not counted towards each other. 457Bs do not have an age 50 catch-up contribution, folks. I get this on a regular basis. No age 50 catch-up contributions for the 457B. But there is a special 3-year catch-up contribution, which is a little bit challenging. The 3-year catch-up contribution is allowed for the 3 years prior to the year in which the participant reaches the plan's normal retirement age. The limit is a maximum of $23,500 or the lesser of the underutilized cap limits. So if I had a plan for 5 years and I maxed out in all 5 years, I have a 0 catch-up limit. But if I had a plan for 5 years and I didn't do $5,000 in each of those years, meaning I had $5,000 of available space in each of those 5 years, so my underutilized limit was $25,000, then my catch-up is the lesser of, so it's $23,500. It's the lesser of the hard number for this year or the underutilized cap space historically. Those are Bs. And by the way, if you have to think about this later and you want to email me, I'm happy to help you at another date. 457Fs are employer-only contributions, can be fixed or discretionary and determined separately for each covered executive year to year. I put that only in parentheses because you very rarely see employees put money in a 457F plan because they become the assets of the organization, right? And subject to creditors. And employee money is vested and taxed when I make the contribution. So why would I pay my Social Security and Medicare taxes on a contribution, give it to the employer, and then subject that to potential loss by creditors? You can do it. Not a lot of people do it. For 457Fs, there's no specific dollar limit or annual contribution limit. So I threw out some numbers, 50, 100, 500. These are all within the parameters of what you can do in a 457F. They're not limited to those 403B and 401k rules that we know. 457Fs do not count towards maximum annual contribution limits for the other plans, so neither of these plans are limited by anything you do in your qualified retirement plan. And rules suggest that executives must perform service for at least 2 years in order to receive benefits of a 457F plan. So you can't just bring someone on for a 6-month, 9-month gig and pay them in the new tax year to help them from a tax basis. Nah, they got to be there for 2 years.
Brian, we do have a question. This person would like to know, is it true that an employee can contribute $23,500 or $31,500 to a 403B and $23,500 to a 457B?
Bingo. Yes. That's what I mean when I say they do not count towards the maximum annual contribution limit. And that's one of the primary goals of 457B is to allow extra tax deferred savings for a select group of people. So the answer is yes. Vesting. Vesting does not mean in this plan what you know it means in a 401k or 403b. So put that out of your brain. We're going to talk about vesting in a different definition. So first off, employees' contributions are always 100% vested. You can't make me wait or change it for my own money. Vesting allocates to limits. Could create problems with the annual deferral limit of 23,500. What do I mean by that? So if we say, okay, executive, in a 457B plan, we're going to give you 20 grand a year for the next 5 years, and it'll vest in 5 years. You can't do that because the vesting means allocation, means taxation. And when you vest in a 457B, that number goes against the deferral limit. So in my scenario, I don't even remember what I said. I'm going to say it's $100,000 over 5 years and full vesting after 5 years. I can't do that because I can't vest I can't have $100,000 contribution go against 23,500. In a 457B plan, when you vest, that's when it counts against the contribution limits. So I very rarely ever see any kind of vesting in a 457B because 23,500 for this year, maybe it's 24,000 next year. It's really hard to create a vesting schedule that will allow the money to stay under the cap limits. But if that's what you're looking for, is somehow to have a longer vesting schedule for bigger numbers, and you're really looking at a 457F, that golden handcuff type plan. So an employee is 0% vested until a predetermined vesting event is scheduled. That's one of the key differences. 457Fs, each contribution has to have a distribution investing schedule attached to it in advance. It cannot be any kind of rolling window. So if I'm going to have a vesting schedule on my 457F, I have to know it before the money goes in the plan, and then it vests, then it taxes. Vesting is tied to a duration of service and or the occurrence of a condition that is related to a purpose of compensation. I can bring you on here and I'm going to give you a deferred comp plan that'll vest in 5 years. Or I can bring you on and I'm going to give you a sum of money that vests when the building is completed and up and running. So it depends on what you're trying to do with it, but the vesting doesn't occur until a future date. If executives voluntarily terminate employment prior to that vesting date, well, it depends on what the plan says. You can give it to them, or you could say, no, we wanted you here for 5 years and you left after 3 years, you get nothing. Or, hey, we respect it, we're going to give you 3/5 of the assets. But the key is, this has to be written in advance because each contribution has to be tied to a distribution. So all the 457F type vesting events have to be written into the document before the money even is contributed. And vesting is taxation. So when that vesting event hits after 5 years, after the building's complete, whatever it is, that full sum of money is taxed. So that's why people tend to not leave money in a 457F after they vest, because I'm paying taxes, federal and state taxes, and now it's subject to substantial risk of forfeiture and subject to the creditors of the organization. No, 457F money, when it vests, it comes out.
Brian, we do have a question. This question is, we know that 401k and 403b limits count against each other, but do 409A and 457B limits count against each other?
No. That was an easy one. 457Bs and 457Fs have different rules. Yes, 409A really is about timing of distributions, but no, they don't aggregate against each other. Okay, buckle in, folks. This is probably this in taxation, but once you get your mind around taxation, it's not that bad. This is the hard part here. Distribution rules, or at least in my experience, my clients, this is the one that creates the most confusion. I've got 9 points here, and I directly correlate 1 to 1, 2 to 2, 3 to 3. So for the 457B, distributions payable after termination of employment. Okay, 457F, payable after a vesting event as per the plan document. So again, that 5-year rule, whether I'm employed or not, It's going to vest. 457Bs, I can defer the distribution as long as I continue employment. It might be a year, it might be 20 years, however long I'm employed. 457Bs, that distribution rule is put out. 457Bs have no in-service withdrawals, but an unforeseeable emergency withdrawal. It's basically the same thing, folks, just a slightly different code in the IRS. 457Fs, no in-service withdrawals or unforeseeable emergency withdrawals. So no options to get it out in the F plan. 457B, required minimum distributions are required. 457F, no required minimum distributions. 457Bs are not eligible for a rollover to an IRA. I'm going to repeat that one. No, I can't roll over my 457B to an IRA program. I can't roll it over to my next job. No, but I can do a transfer if my current plan allows me to transfer assets out and my next employer has a 457B that also allows transfers in. So no IRAs, no rollovers, but a transfer if both plans allow for transfers out and transfers in. Sorry. If your plan allows for transfers out and your new plan allows for transfers in, then you can move money over to your new plan. A 457F, not eligible for rollover to an IRA or to another employer-sponsored retirement plan at all. 457Bs, there's no age 59 and a half distribution requirement or 10% early penalty withdrawal. 457Fs, no age 59 distribution requirement or 10% penalty withdrawal. 457Bs, absent a written distribution deferral election, my distribution, I'm going to defer my distribution. Okay, so if I don't put in writing that I want to defer my distribution, then the plan must pay the assets out per the default distribution, usually lump sum within 60 to 90 days. Let me say that again. If I terminate employment and I have a 457B plan, that plan document has a forced distribution rule. It's usually 60 days, 90 days, maybe 120 days. And I usually have the opportunity to say, no, pay me out in a year, pay me out in 3 years. But whatever it is, I have to put that distribution election in writing. And once I do that, I can never advance it. So if I say within my window after termination of employment and before the distribution, pay me out in 5 years. And then next year I change my mind and say, I want my money now. Nope. Once I put that deferral of distribution election in writing, it sticks. Good news is you can put it out maybe to the next tax year. Bad news is once you do it, you're stuck. 457Fs, distributions are prescribed by the plan document. Employee has limited options to alter the structure and or payouts. I'll talk about that more in just a moment. But 457Fs, kind of like I said earlier, every distribution has to have a predetermined, every contribution has to have a predetermined distribution schedule before the money even goes in. Not flexible at all. I'll come back to that. Number 7, for the 457B, participants may make a one-time additional election to defer, but not accelerate. So in my scenario before, hey, I'm terminating employment, pay me out in 5 years. Well, when 5 years comes, I could say one more time, okay, pay me out in another 2 years. But I can never say, no, give it to me now. So 457Bs allow you to make a distribution deferral election before payment, and then one more if your plan document allows it. But a 457F, little different. If your plan document allows, you may make a one-time deferral election to defer, but not accelerate, if the election is made within 90 days before the distribution is started under the initial deferral election. So you don't get a second crack at this one. But there's a couple caveats. So you can make this deferral distribution election in a 457F if it's 90 days prior to that vesting event, materially greater benefit, meaning the principal has to be 125% of what it is today at that future deferral event. That's going to stop a lot of employers. A lot of employers are going to say, we're not going to kick in another 25% just so that you can defer your taxation. And it has to be at least 2 more years of substantial service. So it can't be defer it to January so I can get the new taxes. 90 days, 125% of what the original balance is, and at least 2 more years. This is where it gets really complicated. Sorry. Distributions can be structured in many ways over many horizons in a 457B. I can take out monthly, quarterly, I can take an annuity, whatever you want to put in writing, as long as the plan document allows it. And most of my documents do actually allow for various options. So participants have a lot of flexibility with 457Bs. 457Fs, nope. Depends on what is in the document, and they tend to not be flexible at all. No loans and no loans. I'm going to pause there.
Brian, we do have a handful of questions.
So.
Referring to number 6, I believe, in the 457B, within 60 to 90 days of what?
Termination of employment. So distributions happen at the termination of employment for a 457B. And absent a written distribution election, the plan must pay out the assets as per the default distribution, usually within 60 to 90 days. So in this example, I'll say I have a 90-day payout provision and I terminate employment. I have 60 days to put in writing, pay me out in January, because the rules say 30 days prior to that forced distribution. So the plan document will say, if you don't put it in writing, 90 days later, you have to get paid out. It's a forced payout. And you have to make that deferral election in writing 30 days before that forced payout happens. And this is all based off of termination of employment date.
Next question, also for number 6 on 457B. When must the written distribution deferral election be written?
From termination of employment to 30 days prior to that force out. So again, whatever the plan document says, 60, 90, 120 days, that's already written into the plan document. So you just have to go see what it says, and it'll say the default distribution will be 90 days, 120 days, whatever it is. So 30 days prior to that default distribution.
Next question, what's the default distribution in 457B?
100% payout. Lump sum payout. Now, that's in my experience. The plan document is going to define what the default payout is. I don't think I've ever seen anything other than 100% lump sum. But you could, in theory, require some kind of systematic payout as the default distribution. But it's, in my experience, it's almost always 100% payout on the 91st day or whatever the number is.
All right, last question from this slide. Upon distribution, are state taxes based on the current state of residency or the state where the earnings were made?
Taxation. I saw that question. I don't know. Lindsay, if you can just earmark that one, I'll get back to that person. I want to say it's where you reside, but I'm going to look it up. I'll get back to whoever that asked that question.
Will do.
Any other distribution questions?
Not at this time.
Perfect segue, whoever asked that question, into taxation. So W-2, 1099, what are we talking about? When are we talking about it? So for the 457B, taxed for federal and state when distributed. 457B, employee contributions. No, actually, I'm going to go plan by plan. 457B are taxed for federal and state when distributed. For the 457F, tax at the federal and state when vesting occurs. Slight difference there. For 457B, employee contributions are subject to Social Security and Medicare taxes as if the employee had received the compensation. Same thing for the F. But employer contributions are subject to Social Security and Medicare time at the time of vesting. Since almost all employee contributions to a 457B are 100% vested, FICA and FUTA should be withheld at the time of contribution. Again, going back to that vesting schedule, not a good idea to put vesting schedules on salary deferrals or even in a 457B at all time. Employer contributions to an F are subject to Social Security and Medicare at the time of vesting. So here we have vesting, here we have distribution and vesting. For the 457B, many vendors will issue a W-2 for participant distributions. Same thing with the F. When vendors can't or won't issue a W-2, they'll return money to the employer to be processed through payroll. So with the 457F, though, federal and state tax occurs at vesting regardless of whether participant's benefit is paid. That's the key to me. And then, yeah, it goes on the W-2. Other tax questions other than the one that I'll get back to the person on?
Not at this time.
I expected more questions there. Okay. Investments. So remember, they don't have to be funded. They can be unfunded. But for funded plans, any objective and market-driven investment that offers a reasonable rate of return and is available to the public. See your vendor, though, for specific limitations. If you're a small plan, they may not make anything available. If you're a large plan, they probably will. And I put a footnote on stable value, quote unquote, stable value. Stable value investments may or may not be eligible depending on the other investment product structure registration with state or federal agencies. So if you know what a stable value is, generally they're not available in 457B plans, but there's an insurance, quote unquote, stable value that you can use. Practically speaking, what we're talking about are mutual funds or brokerage accounts are realistically what you're going to use. Often with a 457B, because, well, we hire an employee to have them around for an extended period of time, we'll just mirror the qualified plans investment menu and do the same thing for the 457B. For unfunded plans, though, it doesn't matter, right? Because it's unfunded and is owned and registered only to the employer and taxed at the employer level. It's not a deferred asset. It's a promise to pay you at something in the future. Participants' investment horizons may preclude more volatile investments. I had worked with the hospital 14, 15, 16 years ago, something like that. And when I first came on, they had a contribution schedule that vested every 3 years. So a contribution was made in 1 year, 3 years later, it vested, and so on and so forth. And when I looked at the plan, the 457F was invested in equities and a bunch of small caps. And I talked to the committee and just simply raised the question of, do you think the employees understand that if small caps are down, they could effectively lose their entire tax benefit of these assets? And they're like, what do you mean? Well, markets can be down for an extended period of time, but the vesting is 3 years. That's a really short window of time. So if markets go down and it vests, person just lost their entire tax benefit because they lost 20 or 30% in market returns. The next committee meeting, turns out I was speaking to the investors. The next committee meeting, those assets were all out of the equities and fixed income components. So that's what I mean by with an investment horizon with a 457F. Do you really want to invest it in equities if it's going to be paid out in 2 years, 3 years? Maybe not.
Brian, we do have a question.
Yeah.
And this may actually be going back to the tax page. Is the whole amount taxed or just the original principal? Are gains also taxed? Asking for both F and B.
The whole amount is taxed because remember, these are deferred assets. So the whole amount is taxed for federal and state. And on the F plan, let's see, the whole amount is taxed on federal and state. And the F plan, the whole amount is taxed whether it's distributed or not. Now, with the F plan, you actually could choose to leave the money in there. Again, I don't think it's a good idea. And if you did leave it in the F and then took it out a year or 2 or 3 later, you would be taxed on the gain as well. The F is only taxed when distributed. The B is only taxed when distributed. The F can create a tax basis when it vests. But again, most people don't leave money in an F after it vests. Common errors. This is me working with my clients. Misapplying governmental 457B, tax-exempt and 457B rules. The idea of rollovers, I get that question all the time. Like, can we do a rollover? I was looking online. It said I can do a rollover because you were looking up the governmental plan rules. So when you're looking at online, make sure you're not reading governmental 457Bs. What's a governmental 457B? You know, a state, a municipality. A 457B is basically a 401k or a 403B of a governmental entity. So they have very similar rules. But if you're looking up the rules for tax-exempt 457Bs, make sure you're not looking at governmental rules. Top hat requirements. Often when I take on a new client, they did not have a top hat filing. I don't know why. I mean, I guess I do. It's just a weird thing, right? You know, record keepers are going to say, here's the plan document, check your boxes, sign it, and be done with it. And it's on the client to understand that they have to file the top hat exemption with the DOL, but that's a very common issue. Limiting eligibility to a select group of employees. I often hear, well, can't we just make it available to everybody? No. That's not the tax deal you're making with the IRS. Not filing that ERISA top hat exemption, top hat requirements. Oh, looks like I have two things here same time. Sorry, not filing ERISA top hat exemption. I just spoke about that. 457B limits are combined for employee and employer contributions. So I'll hear that question all the time, which is the participant wants to max out their 23,500 in the 457B. Can we also put in an employer contribution? No, 457B only has one limit, and that limit is for employee and employer combined. It does not exceed the 23,500 for this year. Unenforced distributions. I often see that the administrator of 457B does not realize that the plan document requires a forced distribution after 60, 90, 120 days. They just don't realize it. They think it's like a qualified plan. An employee leaves and they can leave the money in the plan. No, that's not true. There is a forced distribution rule, and I see that regularly. And transfer, not rollover. Can I roll my money over to an IRA? No, you cannot. Can I roll it over to my new employer plan? No, you cannot. But if your plan allows for a transfer out and your new plan allows for a transfer in, then you can transfer your 457B from one employer to another employer. So 457Bs can be valuable tax favorable reward or retention plan, but both the plan sponsor and the participants need to understand the rules and investment horizons. Finally, top hat exemption letter removes the plan from ERISA status. Questions?
We don't have any at this moment, but let's give folks a minute.
I just realized you should have my email up here to allow somebody to email.
I can answer the first question. Will you receive a copy of these materials? Yes, I will be sending out the recording and slides within the next day. And then the other question we have is separate letters are needed for Band F.
I think what that's saying is, do you need a separate contribution schedule for each 457F contribution? The answer would be yes. Or separate levels for 457F bands?
It's for top hat letters for both B and F.
Oh, yeah. So yeah, yes. You're filing an exemption for a plan, and you're filing an exemption for a separate plan. Yes. Because that person looked up the search function and didn't find their plans. Anything else, folks? Lynn's, anything there?
Nope, nothing more.
All right. I'll get back to that one person that asked that question. And if anybody has questions, my contact information is on the website. You can reach out to me and I'll respond back as soon as I can. Thank you all for your time and attention today. I hope this was valuable for you. Take care.